And one more time, we're live. Good morning to everybody, and thank you for joining us this morning on this morning's edition of Behind the Markets. It is Wealth Wednesday. We're having a conversation today. Main headlines we'll be talking about. Zambia sugar results came out yesterday. We'll be doing headlines for that. Bank of Zambia announcements for today. And we've got a few more stories. We've got a bit of a tiff at NAPSA. There's been a battle regarding some of the monies that's coming out. I think there seems to be something going on there. But yeah, we'll be having a conversation about that also, as well as we get into some outlooks on oil, some outlooks on copper, and then we'll be getting into today's main Wealth Wednesday conversation: asset selection. Okay, because today we're talking about investing. We're going to be talking about asset selection and what to do, where to place money, because I think there's been a conversation. There's what I call, and I know that it's a very sensitive word in our country, but what I call financial tribalism when it comes to investing. Everybody kind of has this clan they're in. No, this is the best, that's the best. I want to try and help people demystify what to actually do with that. You want to stick in if you want to try and understand where to navigate, because there's so much narratives around investing. There is no factor driven based information, and that's one of the things we should be looking at. Especially if you've dealt enough with institutional funds. I wanted to always just give people a headline that I've dealt a lot with institutional funds, and I've seen the way they make investment decisions. It's very different to the way you and your friends make them. Okay. And if you actually looked and peered into the way institutional funds, be it banks, be it especially pension funds, if you look at the way they make asset allocations, and they do it in a very clean and methodical way, you'll start to understand there's a lot of emotion you need to get rid of whenever you're doing this. But anyway, Vernon, how are you doing before we get kicked in?
Oh, we're doing great. I don't know how best I can stress it. We're doing very well. I don't know the excitement. We're quite elated, very ecstatic, in a good way.
Always will be, always will be. Let's get started. Right. So today, as I said, it's Wealth Wednesday, 17th of May, 2023. We are almost halfway through the year. It is time to make sure people, this is the first half of the football game. Okay. We're getting towards the first half of the football game. I think like you'll understand this analogy. Okay. We're
Yeah.
on minute what? We're there. If we're to break a football game half down, you guys realize, or you people realize, that we're into those last 8 minutes, or those last 7 minutes of the first half. So 7, 8 minutes of the first half. So play well, because second, trying to come back from being walloped in the first half is hard, guys. It's hard. Okay, we'll be seeing whether our legends can come back from the Barcelona legends. That's a different conversation. Let me stay away from that before football fans start coming for me. Right, let's get into our market roundup for today. Market roundup is showing that the kwacha has continued down its slide. Now the dollar's gotten into a holding pattern. So as we've seen, that we are in a buying session for the dollar, up 1.62% in the last 30 days, up 1.58% in the last 7 days, and up 2.49% year to date. So you can see a lot of the recovery that has come back on the dollar, especially in the last 30 days. We're just above the last 30 days, mainly because of that last shock that happened during tax season. And once that wore off, we actually started to see strong buying back. This is a problem, by the way, we're having with the currency. It's not wobbling. Your currency is stable when it wobbles within a range. So maybe let's say it's stuck between 18.4 and 18.5. We apologize. It appears that Zesco has visited Vernon somewhere between 18.4 and 18.5. But as you can see, that the kwacha seems to be moving in a direction, changing back, moving in a direction, changing back. That's very unhealthy, extremely unhealthy when it comes to the FX rate. Now, also looking at the stock market yesterday, it didn't move anywhere an inch, up 2.07% in the last 30 days, 11.08% year to date. It actually has been flat consistently, while the bond market moved up by 0.06%, but down 0.47% because of the strengthening of the dollar, while we saw the interest rates are still just teetering under the 23.9 mark. Just something that we should be paying attention to coming around this morning. Next piece of data we actually have taken a look at today is where we've seen even the rand. Rand has moved up by about 1.02%. still down on the week and on the month and still year to date. So we still have a rand that is wobbling within the loss, but it is starting to gather a bit of momentum. As you've seen, the last 55% of the last 30 days, we've seen that the rand has actually gone upwards. So we are starting to see a little bit of acceleration kicking in, though it's still trading below its 200-day moving average. That's still a signal. We are seeing the rand getting back to some sort of strength as well, and that's a bit risky for us who are dealing with either cross-border traders, or you're trying to deal, or you're dealing with either cross-border traders, or you're attempting to deal with imported goods. So cross-border traders might want to take a little bit of an eye on. It does look like things are starting to pick up a bit, but if you're obviously getting your stock on a monthly basis, you'll probably find that your import costs are still a bit low. Remember that it's down 3.49% on the month. South African inflation is still having a problem, but today we'll be talking more about South African unemployment. That's actually one of the biggest concerns hitting the market. We also did see that our GRZ bond index, as we said, up 10.39% year to date. While we're also looking at the US one up 7.71%. This is actually coming down because of the strengthening of the dollar. Interest rates are up only 0.35%. Remember, they were up much higher than this. We're now wobbling down below the 23. So below 24, when we extend it to 4 decimal points, we are seeing it below 24. So we are actually getting a little bit of a strengthening back in our bond market. Commodities markets, we also are seeing that copper dropped down 1.8%, while oil stayed hovering low 0.15%. Copper dropped mainly because of weak Chinese data and concerns that China is struggling to actually get into the recovery that everyone expects it to. Gold also dropped down 1.15%. By the way, all of these copper, oil, and gold also are a result of the US debt ceiling talks. Janet Yellen yesterday gave out a warning that there is a probability that America will run out of cash by the 1st of June. That's why everybody's kind of panicking a little bit. America is likely to run out of cash by the 1st of June, and you might see some worries on bonds that were issued a little bit earlier than that, especially treasury bills and bonds in America, not in Zambia. In America, not in Zambia. I'm going to stress that again. Bonds issued by Americans. Okay, the worry is the American bond market, and that might have a spillover effect on the rest of the world because it raises interest rates. Short-term interest rates are trading above 5%. Money is flooding into money market funds. Short-term interest rates are trading above 5%, and there is pessimism about the American economy going forward. But you are starting to see it playing out in the commodity market, as you can see. Copper down 1.88%, oil down 0.1%, and gold even went down yesterday in dollars. In terms of wealth insurance assets, we also did see cryptocurrency down 1.2% in terms of Bitcoin. It's been teetering around this 490 to about 550 range. So you can see that somewhere in these last 2 months, we've been seeing that the Bitcoin in Kwacha chart has actually been doing that. Remember that you can buy a Bitcoin down to the one over 100 million. So 100 millionth of a Bitcoin, which is called a Satoshi, which is what you can actually acquire. So remember that Bitcoin actually comes down to the lowest fund itself, but up 66.83%. Remember, this is a highly volatile asset. It is down 2.36% on the year, but up 66.83% year to date, up 0.7% on the week. You can see this thing swings a lot. So I tell people, keep it around 5% of your portfolio. Bitcoin, Ethereum, all of them combined. Keep them around 5% of your portfolio. When they're overweight, sell them off. Okay, these things can be dangerous if you hold too much of them in your portfolio. Another warning again, don't overhold them. Okay, that they can be dangerous. Okay, especially if you're a novice investor. If you're trying to get too rich on things like this, it can catch you on the back foot. Now, take a look also at gold. Gold also down in Kwacha 0.6% because of also the weakness of gold itself, as you saw in the previous chart, down 1.15%. Even though the dollar got stronger, you saw gold also push down about 0.06%. But year to date, gold is up 12.6%, Ethereum up 55.6%. Now, if you take a look at the charts of where we are cross asset, we are seeing that our cross assets are up 10.4% in bonds, 4.3% in real terms. By the way, I've subtracted inflation. Latest inflation reads will be coming out as well in the next couple of weeks, so we will be updating the real return parts as well. But for now, we are assuming that about 4.3% is where the bond market is sitting, about 5% on the stock market in terms of real return. US dollars are still down 3.6% against inflation. Gold is up 6.2% against inflation, while Bitcoin up 60.7%, Ethereum up 49.4%. That's where we are. And I reiterate the core. Please balance your assets by risk, not just return. If you look at this chart and you start running your money according to just how high the returns are this year, you are the people who lose money. Okay. So you have to be very careful. Always make sure you balance how risky an asset is with also how much it's making in return. Balance risk and return. Okay. That's like selling. I want you to think about risk and return just quickly. I'm going to just segue here. I want you to think about risk and return the same way you think about the cost of things. Okay. You can I can tell you that you can sell cups. Okay. And if I told you that a paper cup is 2 kwacha to sell but costs you 1 kwacha to buy, that's a 50% margin. That's a profitable cup. But if I told you a glass cup is, I don't know, I'm just throwing a number out there, 8 kwacha to buy and 10 kwacha to sell, that's a 20% margin. So you always have to measure the cost of something with the price you are getting for it. It's the same thing with investing. The return you are getting plus the risk you are facing. So always make sure that you subtract the risk from the return and it tells you the real picture. Because this is the mistake many people who put their money in markets make. They do not measure risk. They just see rate of return. This is why farm scams swindle people all the time, because people just look at how much money they're making. They don't look at the probability of how much they can lose that money and then measure that probability versus how much they're making. When you measure probability of loss versus the amount you stand to gain, you then get a clear, broad picture as to how your assets are going to be doing. Right. Also, just another thing that we're looking at here is oil. How's it doing so far? We're expecting oil to come down at the end of this month, 0.96 kwacha or 3.47% on the expectation that we've been seeing global Brent prices coming down 10.02% on this whole battle of the debt ceiling, and also a 1.7% decline on the kwacha has actually put pressure downwards to push the oil prices in the negative position. So we should be seeing pump prices come down. However, this is just the estimation model. It is not the exact thing that comes out of the Energy Regulation Board. They have got many metrics that they also have to assume in that. We also have to look at the diesel price, the transportation price, the processing price. Those are various factors that do not unfortunately fall into this model, but the calculator is something that is based on the ERB's cost plus model, where they did release the formula many years ago, and we've been following that since, especially when it comes to finished goods. So we'll actually be looking at some of that going forward. Now, if we're also looking at what we're looking at from our four horsemen from yesterday, we did see that Canadian inflation did start to slow down. U.S. capacity utilization started to pick up, meaning that inflationary pressure from U.S. products should start to slow down as well. U.S. crude inventories rose by 3.4 million barrels, meaning that we're expecting that that's also putting more pressure on oil prices. However, Italian inflation up, showing that some areas of the EU, such as Spain and Italy, are experiencing higher interest rates. And U.S. Federal Reserve Neil Kashkari, Federal Reserve Minneapolis Federal Reserve President Neil Kashkari said that inflation fight is still on. And he says that we've got a long way to go. We did see U.S. one-year treasuries go up to 4.6%. Americans are getting huge interest rates on their short-term bonds. So they're getting about 5%. So that's why there's a lot of money sitting in cash in America. Treasury bills and fixed deposits in the USA are currently returning about 4.6 to about 5%. And that's why nobody's willing to start coming to Zambia on those markets, because they're making a lot of money on their short-term interest. Yes, there is quite high inflation, but going forward, they're expecting that inflation to come down into the 2 to 3% range, probably in the next year or so. So therefore, if they're holding 5 to 6% instruments, by then they would have made a 2% gain on a very, very low risk asset. So I think that's what they're looking at. But unfortunately, this debt ceiling conversation is actually starting to frighten people a little bit. UK earnings and employment both accelerated upwards. We did see UK earnings up about 6.7% versus the 6.6% last month. So we're starting to see their earnings in terms of the earnings of individuals are starting to go up ex bonuses. We also did see EU employment accelerate upwards as well. 180,000 jobs created in the European Union in quarter 1. We did see that UK employment also has also risen to 3.9% due to higher levels of labor force participation, while the EU GDP remained flat at about 1.8%. South African unemployment rose again. And it's actually getting close to 33%. Almost 1/3 of South Africans are unemployed. Now, this is different because in Zambia, we like to say that a very small portion of Zambians are unemployed. But that's because of the way we define employment. South Africans are very careful not to utilize the informal definitions that we utilize for employment, while we actually capture a lot of the informal sector. So if you actually capture the formal sector, you'll only find about 10% of the adult population are actually formally employed. That's where the problem comes. You've got a large swath of people who are informally employed. Now, even if you capture self-employed plus employed, you're still dealing with just about 1 million plus people, about 1.2 million. There's 230,000 self-employed. Sorry, yeah, it's about 230,000 self-employed people as according to the 2021 labor force survey. While you're looking at about just about 950 to about 1 million fully employed people out of the 10 million adult population of this country. 10 million people above that. And if you look at people who are employment age, and I'm looking at 25 upwards, that's about 8 million people anyway. So still, we're less than 1.5 million out of the 8. So literally it's only 1 in 6. So if we were using the same definitions that South Africa is using, our unemployment rate would be looking much higher as well. And these are some of the things we have to take into consideration, especially later on when I start talking about assets, asset selection, especially in the property section. Now, if you're also looking at other data that we picked up here on the industrial side, Canadian manufacturing sales are also back up on the rise, and U.S. industrial production was also slightly up. So we're getting mixed reads here. Inflation is still cooling down with some pockets, and some central banks are still in fight mode. So interest rates are still up from there, while interest rates and yields due to the U.S. debt ceiling fight are actually starting to pick up. So higher interest rates means it's still less likely that people are going to come and buy our bonds, push our FX rate down. That's still unlikely to happen in the short run until we get over this hump of the U.S. getting out of their problems at the moment. International trade, we are seeing some mixed reads here. While some countries are slumping, we're starting to see earnings starting to pick up in some areas. U.S. retail sales were also mixed. The control group was up. So there's mixed data coming out in terms of international trade, while industrial is still looking a little bit like this strength starting to pick up in the industrial sector. That's not going to reflect this year or the next when it comes to copper. And though the main stories that we're picking up today, Zambia Sugar delivers a 16% profit growth in H1 2023, ending February 2023, but no dividend due to their negative cash position. We are seeing the Bank of Zambia, and this is my expectations, expected to raise based on cash pressure because there is about we're looking at that NAPSA money that's gone in, money that's been injected from paying back suppliers. So we've got 3.3 billion kwacha that's been used to unlock domestic arrears. We've got 4 billion kwacha that's been injected through NAPSA, and over another billion kwacha that's been injected through Zambia National Provident Fund payments. We're looking at close to about 8 billion kwacha that's just been jump-started into the economy through the financial sector, and it's gone into spending hands. So a lot of that also puts pressure on our FX rate. A lot of it also puts pressure on our inflation. So I do see inflation still being pushed up a lot by the amount of money, the sheer force of money that's going in, especially through these NAPSA payouts, and what that's going to be doing to the price of things. If you think that's going to pressure the price of milli meal to go up because we haven't produced more milli meal, we've just added 4 billion kwacha more cash into the system in less than a month. Okay, that's going to push the milli meal prices up probably, and also the slight possibility of maintaining. There might be a slight possibility of maintaining, but right now they're in an inflation fight. We also seen that South African Reserve Bank estimates that load shedding is costing South Africa 899 million rand a day, or at least 2% of their economy. That's something that we are seeing that's of concern from the SA Reserve Bank. Other news that we're also seeing is that 65% of global fund managers are pessimistic about the economy and expecting that in the second half of the year, there may be a soft landing, but there's expectation that there'll be a small contraction in earnings. So therefore, cash levels, everyone's holding more, 5.6% more cash in the month of May. They have risen their exposure to equities. They have bought more bonds, but they're really pumping up more money into cash. And we're seeing cash levels at the highest amounts they've been because of the interest rates that people have in US bonds. So you can see that money that would have been coming into Zambian GRZ bond auctions is now going into US certificates of deposit. It's going into treasury bills. It's going into fixed deposits in US banks because people are getting 4%, 5% return on investment in those areas. And they're much more comfortable doing that than coming to Zambia to potentially face currency risk. That's what they're trying to get away from at the moment. But once those returns start to come down, then they come in either through a recession or either through finally the inflation fight ending and this debt ceiling thing coming to the end. That's when you'll see a lot more flight into markets like ours. But also once we also sort out our debt. Remember, that's the barrier that's stopping people from coming in. Copper prices dipped to the lowest since November due to weak Chinese data, even in the face of Chilean underproduction. We'll be talking about that soon. Gold prices touched below 2,000 at one point with the debt ceiling getting closer, and oil prices also in the face of the debt ceiling and also weak Chinese data also came down. Treasury Secretary Janet Yellen has warned the U.S. that they're already paying the price for its failure to raise the debt ceiling as talks pushed into the second week. She said yesterday, we have already seen Treasury borrowing costs increasing sustainably for securities maturing in June. She said in a letter to congressional leaders on Monday, also sticking to her warning that the Treasury of the United States could run out of money by the 1st of June. That's a warning bell that's actually signing around the world. And for those of you who are looking into the crypto markets, crypto policy experts Ron Hammond has actually shared his update saying that there's a likelihood you will see bipartisan support for a new legislation on stable coins such as Tether, such as USDC. There's new legislation that they are trying to push in. But mainly, you can see the debt ceiling conversation is really governing most of the outlook of the market. So keep your eyes on what is happening here. Now, let's get into our deep dives for the day. And that's our market roundup. Let's get into the deep dives for the day. Now, touching into this, we did see a letter yesterday coming out from NAPSA where they did assure the public that they have adequate liquidity for the payouts. In a statement yesterday, or issued on the 15th of May 2023, NAPSA stated that it has 71 billion kwacha in assets, which is 3.3 billion kwacha above where it was sitting at the end of 2022. Composition of assets are 69% in government securities, 10.3% in fixed deposits, and the rest are in less liquid assets. So we're looking at about 80% of NAPSA's portfolio, if not 79.3% of NAPSA's portfolio, is sitting in liquidatable assets. Remember that government bonds are very good, are quite easy to liquidate with banks. So the reason why they're looking at their GRZ bond portfolio, which is 69%, GRZ bond and treasury bill portfolio, is that if anything, they can liquidate these for cash and they can do this with banks. So it's a very easy trade-off between NAPSA and the banks. Plus, they've got still 7 billion kwacha in fixed-term deposits. In other words, cash that they're holding at banks. So remember, what NAPSA is actually doing is, and this is why they're pushing people to do this through banks, is that they've got deposits at every bank in the country. So when you make your withdrawal claim or your pre-retirement withdrawal claim, they are instructing your bank to then take money from their deposit account and move it straight into your account. And this is why those who are getting authorized are getting authorized rather quickly. And I know there's complaints and stuff, but unfortunately, when it comes to this issue, you don't even know who is and who isn't a NAPSA member. Facebook is full of everyone. But some people, yes, are experiencing issues with the online system because, yes, the orders are coming in very strong. Now, obviously, there's a lot coming in, but so far, we have seen that as of May 16, 2023, 22% of the 600,000 eligible members for the pre-retirement withdrawal have withdrawn 28% of the potential claimable funds. So yes, people are pushing money through the system. And this is what I simply mean when I say just in a month, we've actually shoved in about 4 billion. Now there's only about 14 billion really up for grabs maximum. On all of these funds, there's 14 billion kwacha maximum that is up for grabs for people to be able to get. So already they do have the adequate liquidity. If you do have a government security, you know that for banks, that's easy collateral. It's a trade they can do in a day, especially if you're an institution. They can hold that. That's like cash for them, especially if they're looking at the treasury bill component. But just to remind people, where did NAPSA sit at the beginning of the year in terms of their portfolio? This is where they were. Remember, at the beginning of the year, they told us in terms of their 2020 portfolio, they had 23 billion kwacha in government bonds, 14.9 billion kwacha in deposits. Of course, about 4 billion of that has gone to basically paying people off. So I think they're down to somewhere between 10 to 7 of that. They do have about 5.8 billion kwacha in treasury bills, 7.53 billion kwacha in property, 4.6 billion in equity. So this is what they had, with 965,000 contributing members who are putting in 6 billion. So remember that they also are getting contributions coming in. Now, also bear in mind what this whole withdrawal shenanigan has done is that people are reporting their employers from a long time ago. And employers who haven't been paying are being searched now and saying, hey, you owe us. This person's coming to make a claim and you owe us. So now there are lots of employers who have to come up with cash quickly to make sure that they're paying off their NAPSA from historic levels. So this is a reality you're starting to see here. So there is also inflows coming in from this. So they do have money coming in a lot, which they can also use to net off some of this. Remember, as I said, NAPSA gets about 7 billion, somewhere between 6 to 7 billion of contributions coming in. They had 14 billion of cash sitting at the beginning of the year. That's a potential net cash position, about 20. Remember that they only make payments, if you're looking at to pensioners, just quickly, if you look at this, they had monthly payments to pensioners of 496 million, and lump sum payments that were making only 499. Of monthly pension payments, they're only making about 1 billion kwacha worth of payments in a year. So already they can net off from contributions the payments that they're making. The contributors can do that, and they still have a net position they can chunk back in into their portfolio. So you're looking at a net cash position somewhere of just under 20 billion, which they've been able to deal with. And they only had a 14 billion pre-retirement withdrawal liability that was there, on the expectation that they're able to now start nabbing a lot more employers and then probably increase their contributions. They're going to make this money back in the next 5 years. They're going to make this money back because they've caught a lot of employers going forward. And now those employers are the ones who can start swiping, are the ones who are now going to start covering up a lot of this. So I'll tell you who's actually paying for this NAPSA withdrawal. It's the employers who've been non-compliant. Those are the ones who are actually paying for this NAPSA withdrawal. It's actually quite a clever move. We've got a question here from one of our listeners, obviously on this matter. Jebis Piri has written, good morning. I would like to ask on NAPSA, with new goodies in place from NAPSA partial withdrawal on a yearly basis, how would you be going ahead with this? And also, the contributions in the country are lower compared to the working people in the country. Okay, so how would I be going along with this? One, my advice I would give to people when it comes to partial withdrawal is probably wait until your age 40 to 45. You've probably accumulated enough for it to be significant, or you've probably crossed into the amount for people to be getting a pension. By the time you're between 40 and 45, your contributions are probably crossed over 180. Most people, your contributions are probably crossed over 180. Now, the average person is only getting about 30,000 kwacha. Now, I'm saying only because, let's be honest, most people aren't going to do much with that. Okay, you're going to find it spent on a lot of consumption-based activities. But what I would advise people is, one, it is a lump sum. Okay, so I do have a simple law with a lump sum, which I always tell people is half of it goes to wealth building or debt reduction. Okay, one of the first wealth building tools you should get down to is paying down high interest debt. So if you have high interest debt, get rid of that because you know the return on investment. If you're paying 30% a month on money that you borrowed, or even 40% to a bank that you borrowed, okay, pay it off. The reason is that there's a cash flow implication that has on you anyway. So you're actually freeing up future cash flow by the time you're paying that off for you to be able to make better investment opportunities, for you to make investments in the future. So that's one thing. The other thing you should be doing is then also utilizing it for wealth building investments. Now, there are three wealth building investments that I have advised people to utilize those funds for. One is investing in yourself. The first investment any person should make is in themselves because you are the one who makes money. And I say this by saying improve your skills and knowledge and your ability to make money. What is it about you? Are you investing in tools? Maybe you're a podcasting, you're looking at podcasting. Maybe you're trying to give yourself a skill in trading. What do you need to do to improve your ability to make money? That's a very good investment to make. Okay, so your skills are a very good one. The country will bear dividend on it because you'll be able to do it. All you have to do is find relevant skills. Now, these two categories of skills you should be looking at investing in. One is investing in skills in sharpening your skills to become the best in your field. So you want to become a superstar because those are the people who are going to thrive in the great great transition. There's going to be a reorganization of labor markets going forward, and two groups of people are going to do very well in that. Okay, one, people who are good at their things, like rock stars, like really good at what they do, and two, people who are good with technology. So teaching yourself to be really good at something or really good with technology, one of these two will lead you towards a lot more income generating opportunities, especially going into the future. So if you are good at managing technology of your field or the future technology of your field, or you're very good at managing, or you're very good at delivering your service or skill, those are the two things that you should invest in. One. Two, if you have a business idea, this is the kind of money that you can use to give yourself starting capital to test out an idea. Now, all I say is get startup training. There's Bongo Hives, there's Y Combinator Startup School. There's many things. There's startup frameworks you can learn. Just get a basic idea of going through the startup process. Get some basic education on it, just so that you know, okay, you understand how it is to start something. Then sit down with some like-minded people. Get to know some like-minded people in that area. Get into those circles so that your mind is kind of oriented in the right way. Find a market problem. Solve it in a rudimentary way over the weekends. Once you've solved it, then you can take that money out and say, now I want to launch a basic model of it so that I can get this started. Even if that business flops, you've actually learned something very good about that market. You've gotten some entrepreneurship experience. It's valuable. You probably had invested in yourself. And yes, if it may have not worked, at least you tried something. This is the kind of money you want to try and do that with. And for people to get into entrepreneurial ventures, that's a good thing. If you neither can get into an idea or education, you take that money out and you put it into your equity portfolio. You test out a bit more of the higher risk part of the investment spectrum. When I'm talking about stocks, or you maybe start pushing your money into your bond portfolio, but you try and get more higher returns because maybe labor market returns have not been good for your NAPSA portfolio. That's what you can do. Those are the three areas where this money, if it was channeled, would actually improve the economy. Highly unlikely because most people just spend money. These are things you're supposed to be doing before. The people who are going to invest this money are people who are already investing. The people who are going to run businesses with this money are people who are already running businesses. The people who are going to put this money into education are people who are already studying. Now, the number of people who are already studying, who are already running businesses, and who are already investing are much lower. So you want to get these things started before you get that money in your hand, because money in your hand without something on the ground will just turn you this way, and then we'll end up losing a lot of it. So that's kind of what the best thing would do. But most likely people just have taken it, they've spent it, and that's the reality. They've pushed it into the economy to increase it. Probably the biggest winner, I'm being honest with you, the biggest winners out of this NAPS, like the three companies, the three industries I foresee really winning out of this is one, banks, because loan repayments or financial repayments will probably come back in. You'll find a lot of money going back into banks to repay loans and stuff like that. Two, food producers, companies that produce food on beverages. So food specifically, your Zambeefs, your Zambia Sugar. You're probably going to see a lot of people spending on domestic budgets there, just buying sugar and food and meat with it, chisanyama, all sorts of things happening. Three, beer companies. Like that money is going into beer companies. I'm telling you that if you see a huge spike in Zambia breweries' revenue this year, just know it was this. Okay, there's a huge likelihood it was this. Okay, so you might see spikes in Zambeef, Zambia Sugar, and Zambrew revenues. These are the most likely products you will see. And then some banks, you'll probably see delinquent loans finally starting to get recaptured, and probably some improvements happening in the retail sector. That's probably where the chunk of this 4 billion is going to end up going, more than anything, if it's not already going to imports. But remember, like I said, the average person is withdrawing about 30,000 kwacha. So you can see where the majority of this is going. But we do wish that it does end up in the right places to improve the economy, but we know our people. Right, let's also get into our next story. We did see yesterday Zambia Sugar revenue, Zambia Sugar financials came out for H1 2023, the 6-month period ending 28th February 2023. What do we see from Zambia Sugar? We saw revenue up only 4.6% for that 6-month period. That's a bit concerning. That's much slower than usual. But that's mainly because of slow domestic demand due to illicit sales. They've been dealing with illicit imports, which have been coming into the country. While at the same time, we've been smuggling sugar in this country. But at the same time, we did also see export markets do well because the FX rate went weak. The weakening of the FX rate starting in Q3 2022, going all the way into February, actually resulted in a 16% growth in exports. In export sales for Zambia Sugar. We did see that operating margins did decline a little bit, but we saw net margins up 2.2% because costs of production such as fertilizer, chemicals, electricity, employees, packaging, and fuel all went up by 11% in the 6-month period. Mainly fuel was one of the biggest ones. Financing costs also increased by 4% because of off-crop costs that had to increase. So at the same time, you did see Zambia Sugar having to use more of their financing facility, but their gearing ratio did come down from 15% to 13% due to their asset growth. They did actually grow more stock. You did see that their cane sugar supply was up 18%, while their main sugar supply was up 11%. Now, we are seeing a decline in global fertilizer costs and energy costs going forward, even though there's an expectation that energy costs may rise in the second half of the year. Plus, we're expected to start producing fertilizer domestically as a country. So that actually might help companies like Zambia Sugar. Export markets are starting to recover for Zambia Sugar due to the weakening of the FX rate. And also remember that in Q2 this year, we are starting this mingling where we're trying to mix ethanol with blended products. So Zambia Sugar will have a new SKU. Remember that they're expected to cover 10% of the oil supply chain, which should be able to now impact their business with probably potentially hundreds of millions of kwacha of new revenue that should be able to come in to support their business growth. So those are the opportunities we're looking. However, due to their cash position in the negative, we're seeing that they are subject to higher interest rates. Should Bank of Zambia continue its rate hiking, which it's most likely going to do, domestic markets are starting to struggle. Plus, there's the FX risk that'll actually that'll actually slow down and there's the FX risk that might cause inflation in fertilizer costs and fuel costs. So that might be a problem for them going forward. But all in all, due to growth in revenue and also their dominance in the market, I do see a positive outlook for them. They do have some struggles with the illicit market going forward and the domestic demand and potential inflation risk. They did cite that they are worried about inflation going forward, but they did also say that domestic market will probably recover. As I said, this 4 billion kwacha will probably find itself partially in their hands because of how much people also spend on sugar in Zambia and sugar-related products. And I'm also looking at things, like, as I said, like the Ndeni new SKU and also export markets. One of the other things I've also seen for Zambia Sugar, which actually might play into their hands, is that there is a 17% increase in global sugar prices as well, which is making it more likely for them to actually have a good run going forward. Other news that we have seen before we get into other questions is that the green transition is struggling with Chilean supply. Copper demand has been rising due to the green transition, but the world's largest copper exporter has been having problems putting product out on the market. This problem is actually playing due to the fact of socialist policies in Chile, and ore quality have actually been pushing output down for a while. But caught between an EU, US, and China renewable spending, EVs, and EVs in constant double-digit growth, and Chilean socialist policies trying to arrest in rising inequality, we're seeing a potential future price squeeze for copper. So in other words, prices are expected to go up in future, especially after 2025 going into 2030. That's when we're expected to see copper somewhere between $11,000 to $15,000, and Zambia will probably benefit very strongly from that if we can get our output up. Coldeco, this is the Coldeco chart for their output. As you can see, they're currently producing copper at a 25-year low. So that low production coming from the biggest copper production mine in the world is actually giving signals that copper output is a serious problem. And that's why even in the storage, in the Chinese storage, in the LME storage, we're at record levels in terms of how low copper production actually is. Oil demand in the second half of the year is expected to hit record levels. International Energy Agency predicts that in the second half of the year, Chinese oil demand will recover and we'll be seeing 2.2 million barrels more per day. The IAE also reports that we'll probably see a record amount of global oil demand of 103.2 million barrels per day. However, this could trigger inflation, but not for now, due to lukewarm Chinese economic data. And here's the chart. Sorry that it's a bit blurry, but as you can see, the red one is the demand curve, which is currently showing that we're seeing we're heading towards about 104 million barrels, while production is staying at about 102. So what's keeping oil prices subdued so far from second quarter 2022 all the way to now is that supply has been outstripping demand. So we've been seeing international barrel buildups, but we're going to stop seeing that in quarter three, and we're going to see contraction in global oil storage, and that's going to start pushing prices upwards. That's the inflation risk in the second half of the year that we all need to keep an eye on, and also watch out for what that'll do for bigger prices. Now, let's also take a look at we're also getting into our chart of the day, but we've got a question here from Isaac. Can you, sorry, let's get your name. Kanguya, who has said, just a quick question, sir. Do you recommend it's the best time to withdraw NAPSA money? My recommendation is always somewhere between age 40 and 50, age 40 and 45. Most people have got a significant amount in there. That's when let me just tell you this. That 20% is quite good. Let's say you want to build your retirement house. Let's say you're tired of renting, and now you're saying, right, children are out of school, everything, and I want to build the house I want to retire into. Maybe you're not a homeowner. And you've accumulated. Most people, because NAPSA is kept from you, you'll probably find if you've been consistent, you've been working for a long time, but 40 to 45, you've probably accumulated something significant in there. That's a place maybe we can get you 100 to 200 that you can utilize now for building a retirement house. Now, I'm not talking about a fancy mansion for you that'll cost you millions. I'm talking about a retirement flat or something that you can go and retire into, because when you are in your 50s and 60s, you've got less housing needs. You don't have as many kids in the house. You don't have as much going on. So you may find that you can actually live in a flat by that time. So consider this maybe as part of money that you can invest towards your retirement home ownership. In fact, if anything, that is one of the things I would put it to. I actually did once put a proposal through. I don't know if it never got to them, but I actually did say one of the things we should be considering is making sure that pension scheme is also tied to retirement home ownership savings, so that by the time people go into their retirement, they've got a harvest, they've got home ownership. We should have health covered. I know NEMA gives people health, but if you have harvest, health, higher education, if you've knocked that out from the earlier years, in home ownership, if you've got your harvest, health, higher education, and home ownership, those 4 out of your high 5 goals knocked out, your retirement becomes very peaceful. So that's just something that you want to look at. It does play a very significant role there, but there are people who want to be AMA levels. That's the problem. So there are people who want to live on my levels. Like we can't do anything for them. But I'm just telling you that between 40 and 45, that's actually one of your better options for you. So let's take a look at our chart of the day. And our chart of the day has to do with global commodities and the prices starting to come down. Inflation resilient in the face of tumbling commodity prices. This is a Bloomberg chart where we've seen the Bloomberg Spot Commodities Index has been showing that commodities prices are coming down, but US headline inflation is coming down a little bit slower. You can actually see that core inflation is kind of stuck into the supply chain a little bit. So it's coming down a little bit slower, even though raw materials are still historically expensive, but you can see that they're starting to tumble down. Just to even add to this, here's some of the charts that we've seen from the World Bank and the FAO month-on-month global inflation. I know that might be a bit vague, but you can see a 17.6%. Sugar is the only one that's really up. Beverages like tea, coffee, they're up 5%. This is from last month. Timber is up 2%, but everything else you can see is down except meat, which is 1.3%. Everything else was in the negative. So you can see that there is deflation happening. And on a year-on-year basis, this is what you're seeing. Edible oils like cooking oil that we import, 2/3 of our cooking oil is imported. That stuff is down 45.3% globally. Cereals are down 18.8%. Dairy down 15%. Meat down 6%. It's only sugar, which is up 22%. Fertilizer is down 38% globally in dollars. Rubber down 26%. Cotton down 38%. These are all from the main indices. And when you're looking even at the global year-on-year indices for them, such as food, energy, agriculture, metals, and the global world and the full World Bank Commodities Index, you're seeing that there has been a deflation of about 12%, between 12 to 28% in dollars. Globally, we're seeing in terms of our full index, we're down 25%. That's mainly due to the overweighting of energy. But agricultural goods are down 12%. It's only sugar which is rising in price. So this is something that we should be able to pay attention to going forward. Now, I think we're going to get one more question in before we get into our final topic of discussion. We have Christine Mlenga who's asking, what is harvest? Well, the high five goals are something I set up. And basically, the harvest is what you eat off. In other words, it's the cash flow that is going to sustain you in retirement, sustain you or thrive you in retirement. So this is the money that you're able to live off. Now, remember, retirement is not an age, it's a number. It's the time when the money coming in from your passive income assets, be it your stocks that pay you dividends, your bonds that pay you coupons, your properties that pay you rent. And if intellectual property, like maybe you've got books that pay you royalties for the books that you've written, that's another thing. But if you combine all those things, and you look at the revenue they deliver to you on a stable basis, are they able to cover your needs, your wants, and the well-being of your loved ones without you having to set foot in a workplace? If you can do that, then that is your harvest. It feeds you. It's like living on a farm, eating off your harvest. You've kept on replanting the crops of your farm until now you can actually live off the harvest and still keep replanting crops without diminishing it. Okay, you're not diminishing what is happening either in your forest or your plantation. That's actually taking care of you. So you can do that with your monetary, your assets as well. That is what I mean by your harvest. It's the first thing you have to take care of because you need to eat, you need to move around, you need to clothe yourself, you need to put electricity, you need water. You're going to need these things, but you're not going to have the strength to work, nor will you have the wherewithal. So you need assets to be able to generate that for you. And then you also need your health care taken care of. Your harvest, then your health. You need to finance your health care in your older years because your older years are going to be a struggle. You have to really take into consideration this. The older you get, the more sick you start to get, the more frail your body starts to get. So because people don't take care of themselves in their 20s, by the time they get to their 50s, 60s, they're dealing with a lot of chronic illnesses, and we're seeing a lot of rise in those things. The cost of medicating those things is going up as well. So you need to make sure that, one, you're relying on NEMA, but you don't know how that system will work in the future. But remember, and it is getting packed, people. NEMA is getting very popular. So some people can also start doing something called post-retirement healthcare financing, where you can start putting money aside as part of your harvest so that part of the money coming out, can also pay for healthcare expenses, or you can actually pre-buy an insurance package that can take you all the way into your retirement, all the way to the end of your days, which is what covers it. So that's your harvest and your health. Once your harvest and your health is taken care of, if you funded the higher education of your children, wonderful. If you own your home, you've taken rent away from being a discretionary, a fixed expense to a discretionary expense. That's less stressful. You have a peaceful retirement. Those are the main goals that anyone is looking for. Then you can start looking at huge purchases like I'm going on vacation or I want to go back to school. Those are things that are more discretionary for you to be doing in life, and you can do that now if you want. But the peace that you want in that final part of your life is you really want your harvest, your health, higher education for your children so you're not worrying about them, and your home ownership. These four will give you the ultimate peace into your retirement. All right, let's go into our topic of discussion, which is about asset selection. And in terms of asset selection, one of the things we've often seen is something I call financial tribalism. A lot of people are stuck within what to invest in. What I do want people to look at here is what I ask is, what are the key drivers of certain things doing well? Now, there are only two weather points in this world. There is growth and inflation. Economic growth and inflation are the two strongest determinants. I want you to think about growth like precipitation, okay, the rain. I want you to think about growth because I want you to think about this like the way you determine what to wear when going out of your house. You look at two things when you're looking at what to wear before you look at fashion and your personality and those things. The two key determinants that determine what kind of clothing is appropriate for you to go out is, one, how hot is it? And two, how wet is it? Okay. Is it raining? Is it hot? These are the two questions that you ask yourself when you look at what is the most appropriate. That then zeroes in the category of things that you can be holding. And the same thing is true for assets. How hot is it? Inflation. How wet is it? Economic growth. And you can see it breaks it down into quadrants. This is a quadrant actually we call the Dalio matrix because it was actually created by Bridgewater. And they've actually shown us how this actually works pretty well. Now, if you're looking at rising GDP and inflation, okay, we call that inflationary expansion. By then, you're looking for defensive stocks, things that have got pricing power, food, utilities, essentials, companies on the stock market that have got pricing power. At this point, this is when you can start putting money into land and animals. Okay, agricultural commodities. This is when you start seeing rising inflation and economic growth. That's when you start buying cows. That's when, or not when you start buying cows. That's when, if you own cows, that works. Goats, that works. Your land prices start to go up. An emerging market credit like Zambia's credit would start to go up. If you see something called a Goldilocks situation, you see the stock market does very well. When there's low inflation and high economic growth, it means interest rates are generally low. So big businesses access credit very easily, but customers are paying them very well. So you start to see their profits are rising quite strongly. And also their expansionary activity is less costly. Corporate bonds, because government bonds maybe aren't performing as well. So corporate bonds start to become very good, or high yield debt funds start to do very good. Rental real estate also is quite good in this time because the job market also drives it. And long-term government bonds also do well in recessions. Whenever you start to see economic growth is really down, and inflation is down, when you see both are down and you're in a recession, that's when your long-term government bonds do well. Cash, you start to hold cash in banks. Short-term deposits for the meantime, because you're trying to buy assets during that period. And also a declining economy, which is what we just came out of, I think in 2021, stagflation, is where you start to see government bonds do well. If you're holding gold, you're holding dollars, wealth insurance assets, or as I call them, your cryptos, your cryptocurrencies, for example. That's when those things start doing well for you. So those kind of the things you want to start looking at. Now, I want you to look very carefully at assets as what is driving the growth of assets, because this is where I think people make a lot of mistakes. You have to look at, if you sit down from an institutional fund perspective, they know that these assets are driven by different things. For example, the real estate market is actually driven by the mortgage market and the job market. So you have to, and I'm saying this specifically not to take a dig at it, but you have to understand how to reflect some of the information we get from Americans, and especially American investment gurus, for example, who will tell you real estate's the only thing in the market. They say that because 80% of their population between the age of 25 and 55 are working. Okay. 80% of Americans between 25 and 55 have got full-time paying jobs with an average salary of $6,500 in a household. Okay. So that is why, and they've got a 5 million household shortage in terms of willing renters. Okay, so this is what you need to recognize. Secondly, 60% of Americans are homeowners at the same time, and they're doing it through the mortgage market. So they've got access. About more than 2/3 of homeowners in America are able to do it through mortgages. So the strong mortgage market and the strong job market has actually created a very strong real estate sector in America. Unfortunately, when you reflect that back to Zambia, we do not have the same dynamics. We only have 1 in 6 adults between 20 and 25. In fact, I'm going to say this very carefully. 29% or less of adults who are under 40 are working. 1/3 of adults who are between 20 and 65 are working. Okay? A full, and if we're talking about formally employed, that number gets even worse. We're now at about the 11s and 12%. So we're not really capturing a lot of people who are working. Okay, so our working population. So you have to be careful about the houses you are building, because you must bear in mind you're not dealing with a majority formally employed population, just like the US is. They've got about an 80%. Zambia's is much lower. Simultaneously, we've got a smaller mortgage market. The amount of mortgages that are in the system are less than 10,000. There's less than 10,000 residential mortgages in this country. Okay, there's very few residential mortgages in Zambia. Okay, while at the same time you have you in America, you've got 60%. So when they say they've got 60 to 70% home ownership in America, 2/3 of that are people with mortgages at banks. So it's very easy to get your house bought. Whenever you build a house, it's very easy to get it bought and sold in America because there's a mortgage market that supports it. While in Zambia, you find yourself, when you're trying to sell your house, struggling to sell it because you're waiting for the market to recover. You're waiting for people to have cash to be able to buy your house, or else the price has to come down drastically. Okay, so you must remember the dynamics behind things. So as I said, real estate is supported by a strong mortgage market and a strong job market. The stock market is supported by a low interest rate market, and also a growing economy with low inflation. Why? Because that supports corporate profitability. Low interest rates, low inflation, high economic growth drives corporate profitability. So you want to start, you're betting on the drivers. When you are buying an asset, you're actually indicating that you're betting on the drivers of that asset working. While the bond market is driven by slow economic growth, because the government therefore cannot rely on tax revenue, and they've got a high inflation, high costs, or they need to stimulate. So slow economic growth and high inflation leads the government to borrow more in the short term, therefore driving yields of bonds up. So you need to know what drives the assets behind an asset boom for each of these, for you to be able to make that asset decision. So just to take that step forward, for you to be able to look very carefully, okay? That's why I was saying, look at this map and you'll see it's telling you what assets perform in what in situation. So, because I've seen this conversation happen, drift from the US to here, and people will say, but this guy says this guy says that. Yes, context. Yes, I know that when people say never buy a property because why buy when you can just put down a down payment and borrow? Because in America, a mortgage was 2%. Renting a house is 7% of the house. You were making 5% profit just from borrowing for that house and then having the tenant pay back the rent. Still a risk, but that was the math. But in Zambia, a mortgage is 16 to 24%, while rent per income is about 5%. You are losing 11%. You must do the math very carefully. Okay. Borrowing to buy assets in Zambia, be it stocks, bonds, or property, it's a bad idea because our interest rates are very high, especially to retail people. Very, very high. Unless you've got access to a low interest loan, that's a very difficult thing to try and now to utilize for a mortgage. So that's just one of the things. But I wanted to quickly give you just as I said, the 4 areas you wanted to look at investing in. I used Genesis 2:10, a river from Eden flowed and broke into 4 branches. Investing is basically taking your income, splitting it into one or more of these 4 assets. You want to try and diversify because those 4 driving conditions I spoke about can happen at any time. And once those driving conditions kick in, that one goes up, and the one which suffers in those conditions starts to suffer. So the bigger you get, the more you want to diversify. At the beginning, you want to start with a single asset and start small and steady. The bigger you get, the more you would like to diversify your portfolio. So the final thought I'd like to give you is here. The final thought I'd like to give you is here, coming from, well, the first thing I wanted to give you was here coming from Robert Hrishevik, who actually was having these thoughts on this.
$1 million. The game is this. You have to invest it. This is the last million.
The last million.
The last milli.
I would invest in something.
Yeah.
Real estate.
That's a perfect answer. Why? Why real estate?
Got to take desperation out of the equation. So I believe in myself. I believe if I have nothing, I would become wealthy again.
Yeah.
But if I'm down my last million, you know what I got to do? I got to build a foundation.
Yeah.
So I would take that money, I would invest in real estate, I would get an income stream, and I would forget it existed. And then I would go out and do other.
So
Very good.
So the reason why that's an important answer, why I put that there, is because why I wanted to put that is even for the entrepreneurial audience, there are people who bank their lives and their retirement on their pension, on their business, the business they're running. And I know we've just gone over a bit. One of the things you really have to pay attention to is you need a steady flow of income. That's why I advise as many entrepreneurs as possible, especially when you get big chunks of payout, go into the bond market strong. And the reason is that you need that steady flow. It takes the desperation out of your equation, gives you that harvest so that you can focus with a clean mind on how to make your money. And finally, when it comes to picking assets, as I said, do not be a financial tribalist. Ray Dalio, while everybody's in the face of saying, this is the only asset, this is the only asset, this is the only asset. Everybody loves saying this is the only asset. Ray Dalio put this out very importantly. The most important thing in investing is to diversify well, because I can guarantee you that your assets, one of them, and you won't be able to pick which one, could end up being disastrous in your lifetime. And you will lose more than half of your savings if you have picked the wrong one, and you won't know what the right one is. So pick differently. Okay? It's the same way you pick different clothes, pick different assets, especially once you've passed that 1 million mark, and you can do that. That's very possible. You need to start splintering your assets into different things, because the bigger you get, the more fragile you get. And with that, I'd like to thank everybody who's been with us today. And if you have more questions, please pile them in. Thank you for sticking around with us. Tomorrow, we will be talking more about the entrepreneurial game, and we'll be talking more about becoming an anti-fragile entrepreneur and building yourself stronger in that game. So everyone, have a wonderful day. God bless.